Welcome back to How to Design Effective Commercial Insurance Programs. This is part 2 of the series. In this video, we're going to talk a little bit about some of the things to consider in deciding what should be insured. My name is Rick Faber, co-founder of Underwriters Resource. Welcome back. Welcome back to Designing Effective Commercial Insurance Programs. This is part 2, and we will be focusing on what needs to be insured. My name is Rick Faber, co-founder of Underwriters Resource. Welcome. We are taught early on in our insurance careers we should insure everything that is insurable. People are bombarded in the media about making sure they are protected. If something is valuable, then we need to insure it. Over time, I've learned that this is not always the case. As insurance professionals, we need to alter our focus 180 degrees. We should begin to focus on the impact a claim or loss will have on the client. Bad things can and do happen every day. Many bad events happen without having any serious impact on businesses. They happen. Managers adapt and handle the event and move on. For example, there's a retailer that runs a sale on a specific piece of merchandise. They spend money on advertising to get the customers into their store that day. Unfortunately, the merchandise does not arrive on time or not in the quantity the retailer needs. So the retailer decides to either offer another brand or offer rain checks so the customers can still buy the merchandise at the same price on a later date. It was a bad event, which happened, but the retailer is able to manage their operations to minimize or eliminate the impact of the event. One question we should be answering or asking is, what can the insured actually recover from? We take on risk all the time without even thinking about it. Like the example I just mentioned, we incur losses and recover from them all the time. The same principles should be applied to property and casualty loss exposures as well. For example, let us look at the laptop computer that I'm using to record this video. Any number of things could happen to it. It could be stolen, it could burn up in a fire, it could crash, which is probably a more likely occurrence than either a fire or being stolen. As an owner, I'm completely okay with taking the risk of the computer crashing. If that were to happen, the first thing I'd probably do is swear. But then I would go online and order another one to take its place immediately. If I'm willing to take on that risk, why should I be willing to pay a premium to cover a risk of it being stolen or being destroyed in a fire, particularly if they're a lot less likely to occur? Granted, we are exposed to large property and casualty losses as the value of things accumulate and requiring risk transfer to an insurance company. However, we still need to think about other methods to finance recovery for potential losses. For the most part, clients can easily recover from losses greater than the traditional deductibles that we sell, just like the laptop computer example I just explained. Think about it for a moment. At what point does a potential loss begin to cross the threshold from annoying or simply discomfort to being real financial pain, to something that shuts them down or has a dramatic impact on the business? The tipping point will vary from one client to the next, but I guarantee you it's usually well above the $500 or $1,000 deductibles that we usually sell. In some cases, insuring property may not make any sense at all because the personal property values are not high enough to create enough true risk to make insuring it necessary, making other methods to finance that risk more efficient and attractive for the client. So how do we find out just where that tipping point is? There is no single formula, but one thing is for sure. If we are to find that tipping point to make real risk management recommendations to our commercial clients, we must dig. We must get personal. We need to know how our commercial clients do what they do. One area which does not get enough attention by insurance professionals is financial performance. Financial statements provide a wealth of information about the insured and expose areas needing additional focus. We will examine the issue further in a later video, but as my personal observation, agents and underwriters generally fail in this regard. We are either too lazy or too afraid to ask for critical data, which helps us to effectively perform services. This needs to change. That brings us to the end of this video. In the next video in this series, we will be talking about where our insurance dollars best spent. If you found this video helpful, please be sure to like it and subscribe to future videos. If you have any questions about the subject matter in this video, please leave them in the comments section below or email us at richard.uwresource@cox.net. Remember to like this video and subscribe to our channel.